Did you know you can get a mortgage interest rate in the 2s without buying points? It's not easy and you will likely have to pay a lot of money down, but there is a path to get there with an assumable loan. Hey, I'm Chase Gallimore, associate broker with Exit Realty, Shoals, and real estate instructor. If you have ever wondered what an assumable mortgage is, how to find one, or maybe you just didn't even know it was a thing, well, you're in the right place. Well, true to its name, an assumable mortgage is a type of home loan where the buyer takes over the seller's mortgage rather than applying for a new loan. Now, conventional loans, they are not eligible for this type of action, this assumption. Well, they require the loan to be paid in full and a new one issued whenever a property is sold or transferred to a new owner. But not all hope is lost. There are actually 3 types of home loans that are assumable. Number 1, FHA loans, 2 is USDA loans, and 3, VA loans. First, FHA loans. These loans are supported by the Federal Housing Administration, providing financial assistance to individuals with low income who may not meet the criteria for a conventional loan. It's important to note that the new borrower must meet all FHA requirements, including credit and employment standards similar to the previous borrower. Next up is USDA loans. These loans are provided or guaranteed by the U.S. Department of Agriculture for low-income borrowers residing in rural areas of the U.S. Similar to the FHA loan, the new buyer must satisfy the USDA's credit score and income requirements. And finally, VA loans. These loans are available to active or retired military personnel, and they can also be assumed by non-veterans. About 6% of homes for sale across the U.S. are eligible for assumption, according to data from Realtor.com. Yet, less than 0.5% of listings advertise their loan's assumability as a perk, with approximately 29% of homeowners having loans at rates below 3%. Assumable loans present quite an opportunity for home buyers to potentially save hundreds or even thousands of dollars monthly. Sellers can also profit by securing a higher sales price for their home, and despite these advantages, assumable loans remain exceptionally scarce, earning them the reputation as the so-called unicorn of home buying transactions. Now, there are a number of reasons for that. So let's talk about the benefits of assumable mortgages for both buyers and sellers. First, for buyers, assumable mortgages offer a lower interest rate. Right now, the average mortgage interest rate for a 30-year fixed rate mortgage is somewhere around 6.75 to 7%. Now, if you're assuming a loan that was originated, let's say, back in 2020, that rate could be as low as 2.5%. That's going to lead to smaller monthly payments and long-term savings. Assumable loans also offer fewer upfront costs, and because you are assuming it as is, there will be a shorter loan life as well because the previous borrower has already been paying down on that loan. Now, that's a lot of pros, but of course, there are reasons why assumable mortgages might not be the best option for everyone. Probably the biggest hurdle is going to be what you have to pay to assume that loan. Over the past 4 years, homes all across the country have appreciated at record levels. Let's say the mortgage you are looking to assume was written for $100,000, let's say back in 2020. It has a great rate with 3.25%, but now the home is worth $180,000. You can't just tack on the difference of price onto that loan. Instead, you're going to have to work out a deal with the seller to pay off the difference when you assume the loan. So the money you have to pay down could be $80,000, $90,000 or more, depending on how much of the loan the owner has already paid down. Now, another challenge is simply finding a seller willing to walk this path with you. Because it happens so little, it's not a very well-known type of transaction. A seller may be more comfortable finding a buyer that's just going to purchase the house outright. So it's crucial to weigh both the pros and cons carefully before you make a decision about one of these assumable mortgages. But why aren't assumable mortgages more popular if they offer so many advantages? Well, the answer might lie in the complexities of the lending system. Lenders often drag their feet on assumable loans, citing various reasons like financial risk. Once the loan is transferred, the lender really has no say over the new buyer's ability to pay, their credit score, or even their financial stability. This puts the lender at a higher risk of default. However, advocates argue that it's time for a change. Increasing allowable inaudible fees and pressuring lenders could help streamline this process and make these assumable mortgages more accessible to you. Now, despite all the challenges, there is no denying the potential of assumable mortgages to revolutionize the housing market. But finding one, well, that's a different story. And that's a wrap on today's video. Thank you for joining us on this exploration of assumable mortgages. Don't forget to like, share, and subscribe for more insightful content. My name is Chase Gallimore, and I want to be your go-to guy when it comes to real estate.